I want you to imagine a company for a second. And not just any company, but like a massive operation that essentially acts as a manufacturer, a bank, and an insurance provider, all rolled into one giant corporate entity.
Yeah, which is pretty rare, honestly.
Right. I mean, most businesses out there are perfectly happy just figuring out how to make, one single product and get it out the door. But this company, they build the product, they loan you the money to buy the product, and then they turn around and sell you the policy to insure that product against a disaster.
It's basically the ultimate closed-loop system. You're capturing value at literally every stage of the customer's journey.
Exactly.
Don't just sell a physical asset. You're monetizing the entire lifespan of that asset.
And the company we are talking about today is Cavco Industries. We've got our hands on their fiscal 2026 fourth quarter and year-end results, which were just released on May 21st, 2026.
Hot off the presses.
Yeah, exactly. And the mission for our deep dive today is to really get behind all the dense financial tables and the accounting jargon in this report. We want to understand how a massive manufacturer of factory-built homes just pulled off a record-breaking year.
Right, because this isn't merely a story about a corporate balance sheet.
No, not at all. It tells us something incredibly profound about the broader American housing landscape right now.
Okay, let's unpack this because I know they had a massive year, but I want to understand the actual scale of what we're looking at. Like, how big of a year did Cavco actually have?
Well, the headline figures definitely demand attention. When we look at the full fiscal 2026 numbers, Cavco's net revenue hit a staggering $2.245 billion.
Wow, over $2 billion.
Yeah, which represents an 11.4% increase from the previous year. And, it's not just top-line revenue either. Their net income per diluted share skyrocketed to $23.98.
Wait, up from what?
Up from $20.71 the year before. Wait, before we go further, I want to make sure everyone listening is on the same page here. Because when we read earnings reports, they always throw around, net income per diluted share.
Right, the classic Wall Street jargon.
Exactly. So for the listener who maybe doesn't look at corporate finance every single day, can we break down what that actually means in plain English?
Yeah, absolutely. Let's use a pizza analogy. Imagine a company's total profit is a giant pizza,
Okay, I'm with you.
and the shares of stock are the slices. So net income per share is basically how much pepperoni is on your specific slice.
Huh. Okay, makes sense. But what about the diluted part?
Right, so diluted means we're accounting for every single person who could possibly demand a slice. Like employees who have stock options they haven't cashed in yet.
Got it.
So net income per diluted share gives you the most conservative, worst-case scenario look at how much profit each slice of the company is truly generating.
Okay, so going from roughly $20 to nearly $24 a share, that's a massive jump in profitability.
It really is.
That makes perfect sense. So their slices are getting significantly more valuable. And it sounds like that value is coming from the sheer volume of homes they're churning out, right?
Yeah, they actually sold a record number of homes for the year. 20,842 to be exact.
Almost 21,000 homes.
Exactly. That's a 5.5% increase in the actual physical units rolling out of their facilities and onto a foundation.
For anyone listening who has ever tried to build a house or even just do a major renovation, this really reminds me of what Henry Ford did with the auto assembly line.
Oh, that's a great comparison.
Right. Because if you think about a traditional site-built home, it's essentially a bespoke, custom-tailored suit. You have different contractors, you've got weather delays, material runs, custom measurements on site.
Oh, and it takes forever.
It takes forever, and it's incredibly expensive.
Hmm.
So Cavco is basically providing high-quality, off-the-rack solutions to the masses. They're bringing assembly line efficiency to the housing market.
Yeah, they really are.
But I do have to push back on these revenue numbers for a second. I'm looking at an 11% increase in total revenue, but the actual volume of units only went up 5.5%. Are they actually growing their footprint, or are these factory-built homes just getting a lot more expensive for the buyer?
That is a really crucial distinction to make. And the short answer is, well, it's both. But the pricing dynamic is doing a lot of the heavy lifting for their gross profit.
Okay, so prices are definitely up.
Oh, absolutely. The average net revenue per factory-built home sold reached $103,510.
Right.
So that average selling price definitely went up compared to last year.
Right.
And that higher price tag is actually the primary reason their factory-built housing gross profit increased. Buyers are just paying more per home.
Which is something you and I, and frankly everyone listening, feels every time we go to the grocery store or the gas station. Inflation and rising input costs are just everywhere right now.
Yeah, nobody is immune to it. But they are still growing the physical footprint alongside those price hikes. Like I mentioned, the volume of homes sold increased by over 1,000 units year over year.
Okay, that's significant.
It is. And this ties directly into how Cavco's leadership views their role in the market. The CEO, Bill Bohr, was actually very explicit about this in the earnings release.
What did he say?
Well, he framed their entire expansion strategy as a focus on the, quote, long-term need for factory-built solutions to the worsening housing crisis in America.
Wow. That quote really jumps out. I mean, they're positioning a physical product, a manufactured home, as a structural economic solution to a massive national problem.
Exactly. It's not just a product anymore, it's a structural fix.
Yeah, and if you're a prospective home buyer listening to this, you know how wild the real estate market is right now? When traditional site-built homes are pricing average people out of the market entirely, a $103,000 factory-built home starts to look like a serious lifeline.
A total lifeline. But the genius of Cavco's model isn't just that they build that $103,000 lifeline. The real story is what happens after the home leaves the factory floor.
And that is the perfect pivot to the hidden engine of this entire operation, because if you're buying that house, you probably aren't handing over a briefcase with $100,000 in cash, right?
Right. Very few people are doing that.
You need a loan, and of course you need insurance.
And what's fascinating here is how effectively Cavco captures the entire life cycle of the asset. They operate two major financial subsidiaries right alongside their manufacturing plants.
Okay, what are they?
So there's Country Place Mortgage, which handles the lending side, and Standard Casualty, which handles the insurance side.
I remember looking at the financial services segment in this earnings report and honestly thinking the numbers looked like a typo. How much did that division actually pull in?
It's wild. Their gross profit for financial services for the entire year exploded by 112.5%, reaching $50.5 million.
Wait, 112%.
Yep. And if we isolate just the fourth quarter, that gross profit jumped 103% compared to the same quarter last year.
Wait, I'm stuck on something regarding that lending side. I understand they make money writing the initial mortgage for the buyer, but how does that turn into a 100% profit jump?
Right. It seems like a leap.
Yeah, like are they just holding on to thousands of 30-year mortgages and collecting the monthly interest?
Actually, no. The mechanism is highly strategic, and it keeps their capital flowing. In the fourth quarter, their financial net revenue increased in large part because they sold more loans.
Sold them to who?
Well, they secured a long-term agreement to sell these mortgages to a third-party investor.
Okay, could you give us an analogy for how that loan packaging actually works? Because to an outsider, it sounds a bit like, Wall Street magic.
Totally. So think of it like a highly successful local chef who creates this brilliant recipe.
Okay.
Instead of only cooking that meal one at a time for individual customers, the chef sells the recipe to a national frozen food brand.
I see where this is going.
Right. The chef gets paid a lump sum or a royalty up front without having to actually cook the thousands of meals or, worry about the grocery supply chain.
That's incredibly efficient.
Yeah. So Cavco originates the loan, they write the recipe, and they collect their fees. Then they package that debt and sell it to a major investor who actually wants the slow, steady yield of a 30-year mortgage.
Wow, okay. So Cavco gets their cash back immediately to go build another house, and they move the long-term debt completely off their own books.
Exactly.
Okay, that makes complete sense. They facilitate the purchase of their own product, they take their cut, and they pass the waiting game to someone else.
That's the playbook.
But wait, if they're acting as the builder, the bank, Andy, the insurance company, isn't Cavco taking on a massive amount of concentrated risk?
Oh, for sure.
Especially with the insurance side. If you're insuring the physical homes you just built, especially with the unpredictable extreme weather we've been seeing across the country over the last few years, I mean, a bad hurricane season could wipe out those profits, couldn't it?
That is the exact vulnerability of a vertically integrated model. You own the upside, but, you also own the liability.
Right.
And a factory-built home is particularly vulnerable to things like wind and hail damage. But when we look at how they managed this past fiscal year, we really uncover the mechanics of why those insurance margins improved so drastically.
See, here's where it gets really interesting, because a home builder's bottom line is suddenly tied directly to meteorology.
Literally tied to the weather.
Yeah. The report explicitly states that their insurance division margins improved. And it wasn't just because they charged higher premiums. They actually had lower claims losses. Like, they paid out less money for damaged homes. How did they pull that off?
Well, that drop in claims was driven by two distinct factors. One is pure luck of the draw. The report notes a reduction in severe weather events compared to the prior year.
Oh, so literally just fewer storms.
Exactly. Last year, they had higher claims from weather that simply didn't recur this year. Fewer storms blowing through their covered territories equals higher profits for Cavco.
Okay, so Mother Nature cooperated. But, I mean, they can't build a corporate strategy around hoping the wind doesn't blow.
They certainly cannot. And that's where the second factor comes in, which is entirely within their control. Policy underwriting improvements.
Okay.
They actively tightened up how they assess risk.
What does tightening underwriting actually look like on the ground, though?
Basically, it means they analyze the data to see exactly where they're losing money, and they stop writing policies in those specific scenarios.
Oh, interesting.
Yeah, so maybe they stop insuring homes in certain coastal zip codes that are prone to hurricanes, or perhaps they require the home buyer to install specific upgraded foundation tie-downs before they'll even approve the insurance policy.
Got it. So they systematically eliminate the riskiest variables from their portfolio. They structurally optimize their insurance arm to just be more resilient.
Exactly.
Well, tightening up insurance risk is great, but managing this massive multi-headed corporate beast has to come with its own set of growing pains.
Oh, absolutely.
I mean, you have factories, a mortgage company, an insurance firm. How much does it actually cost them to run this entire operation?
Right. So that brings us to their SG&A, which stands for Selling, General, and Administrative Expenses. This figure actually went up for the year to $298.3 million.
Okay, almost $300 million.
Yep. And part of that is simply the cost of success. They had higher incentive compensation because, well, their teams hit higher sales targets. But the bigger piece of that pie is their inorganic growth. They bought another company.
Oh, the acquisition of American Homestar?
Right.
Which they completed at the beginning of the third quarter.
That's the one.
So this year's numbers include 6 months of paying for American Homestar's operations, plus all the legal and deal costs to acquire them in the first place.
Exactly. Because when you buy a competitor, you inherit their administrative costs, their payroll, their corporate overhead. That immediately drives your SG&A up. But to truly understand their expenses, we have to look at this kind of weird accounting anomaly from the prior year to make the comparison fair.
Are you talking about the $10 million non-cash charge from last year's report?
I am, yeah. Last year, Cavco took a $10 million non-cash charge related to the adjustment of certain, quote, legacy brand intangibles.
Okay, let's put that through our Explain It Like I'm Five filter for the listener.
Good idea.
Explain legacy brand intangibles and what a non-cash charge actually is, because honestly, it just sounds like corporate speak for losing money.
It does sound like that. Let's break it down. An intangible asset is something valuable a company owns that you cannot physically touch, like a patent, a trademark, or, in this case, a brand name.
Okay.
When Cavco buys another company, part of the purchase price is paying for the reputation of that company's brand. Over time, accountants have to reevaluate if that brand name is still worth what they paid for it. Last year, they decided a specific legacy brand they owned was worth $10 million less than they previously thought.
Ah, and the non-cash part means they didn't actually write a check for $10 million to someone.
Correct. No cash actually left Cavco's bank account. It's strictly a paper loss reflecting the decreased value of an asset on their balance sheet.
Okay, so it hurt their net income on paper last year, which makes this year's expense growth look a bit skewed if you don't account for it.
Exactly.
So if we strip out that paper loss, the real increase in operational expenses this year is much more directly tied to the American Homestar acquisition. And management seems absolutely thrilled with that purchase.
They really do.
Yeah, Bill Bohr specifically noted that American Homestar is, quote, exceeding expectations for tangible synergies and operating performance. But I have to stop you there, though.
Okay, why?
Because tangible synergies is such a classic corporate buzzword. What does that actually mean for people building houses?
Fair point. In this context, synergies means American Homestar wasn't just a vanity purchase to look bigger. A tangible synergy happens when two companies merge and they can eliminate duplicate costs or, combine their buying power.
Like economies of scale.
Exactly. For example, instead of Cavco and American Homestar both negotiating separately with lumber suppliers, the new, larger Cavco buys lumber for everyone at a massive bulk discount.
That makes total sense.
Or, they eliminate duplicate human resources departments, saving millions in payroll. They are integrating American Homestar's factories into the Cavco machine, and it's basically making the whole engine run faster and cheaper.
Wow. So they're generating cash from operational efficiency, managing risk on the insurance side, and expanding through smart acquisitions. It really paints a picture of a company firing on all cylinders.
It does.
But that leads us to the final and maybe most telling part of this report. You always have to follow the money. We know they are making record profits. But what is management actually doing with that mountain of cash?
Well, if you look at their balance sheet, a casual observer might actually see something alarming. Their cash and cash equivalents drop significantly.
Really?
Yeah, they went from $356.2 million down to $236.7 million.
Wait, so what does this all mean? They made record profits, but their bank account balance dropped by over $100 million.
Yeah, but in corporate finance, cash sitting idly in a bank account isn't doing anything for you. In fact, it's actually losing purchasing power to inflation.
Fair point.
The real metric of a good management team is how they deploy that capital. And Cavco went on a massive shopping spree for their own stock. They spent approximately $160 million on stock repurchases during the fiscal year.
And as if that wasn't enough, just a few days before this report dropped, on May 18, 2026, the board of directors approved an additional $150 million stock repurchase program.
Yep, doubling down.
So, for the listener wondering why a company buys its own stock instead of just keeping the cash, can you explain the mechanics of a buyback?
Let's go back to our pizza analogy.
I love the pizza analogy.
Right, so the company's the pizza and the shares are the slices. When a company buys back its own stock, it's essentially taking slices away from the table and throwing them out. The overall size of the pizza hasn't changed, but now there are fewer slices. This means every remaining slice immediately becomes larger and more valuable. It boosts that earnings per share metric we talked about at the very beginning.
It's basically management's way of saying to the market, we believe in the strength of our own business so much that we are our own best investment. Are they signaling that their stock is massively undervalued?
If we connect this to the bigger picture, what we're looking at is a very aggressive, dual-pronged capital allocation strategy. The stock buybacks immediately reward current shareholders.
Right.
But they're not only executing financial engineering on Wall Street, they're also pouring money into the physical reality of building homes.
Right, because buybacks don't put roofs over people's heads. Where are they spending the rest of that cash?
Simultaneously, in the fourth quarter, they broke ground on a brand new state-of-the-art production facility in El Mirage, Arizona.
Oh, wow.
Yeah, their total capital expenditures for the year were $35.4 million, which is significantly up from $21.4 million the year before. They're literally putting shovels in the dirt to expand their physical capacity.
So they're telling Wall Street, we are highly profitable today with the stock buybacks, while telling the housing market, we are going to build even more homes tomorrow with the new factory.
It's a signal of deep structural confidence. And what makes that confidence so striking is the broader context the CEO provided in his remarks. Bill Bohr noted that the broader economic environment, quote, has not materially improved and remains uncertain.
Yeah, I mean, high interest rates, lingering inflation, massive local housing shortages. The macro environment for real estate is incredibly turbulent for the average buyer right now.
It absolutely is. Yet, despite that macroeconomic uncertainty, Cavco is aggressively investing in its future manufacturing capacity while simultaneously funneling hundreds of millions of dollars back to its shareholders. They firmly believe their factory-built model is essentially insulated from the traditional housing market's volatility, or at least highly adaptable to it.
You know, if you are an investor reading this report, or maybe a potential home buyer trying to figure out how to afford a roof over your head, or just a listener fascinated by a brilliant corporate strategy, this earnings release from Cavco is essentially a masterclass in vertical integration.
It truly is.
They've figured out how to control the entire supply chain, from the raw materials hitting the factory floor in El Mirage to the mortgage paperwork signed at the closing table, down to the insurance premium paid every single month to protect the asset. They own the ecosystem.
And it challenges the very definition of what a home builder is supposed to be in the modern economy. You know, they don't just sell shelter. They manufacture a fully integrated financial product that happens to take the shape of a house.
And that leaves us with a pretty wild thought to mull over. If a single company like Cavco can create this highly profitable closed-loop system for affordable housing where they manufacture the product with Henry Ford-level efficiency, finance it internally to package to Wall Street, and insure it against the weather,
Right.
what happens to the traditional fragmented real estate industry? As housing gets harder and harder for the average person to afford, will the future of homeownership look less like hiring a local contractor to spend 8 unpredictable months building on an empty lot, and a lot more like ordering a fully financed, pre-insured product straight off an assembly line? Maybe the days of the bespoke house are numbered.